do everything.
Yeah, but no, we have to be where the name is. I want to be unique, and I have to be anybody else.
Standing between you and cocktails, so we'll try to keep it all on time. This panel today is designed to discuss in these difficult markets some ideas we have for actually making money. A couple of the ideas are quite quantitatively focused, and some of them leave much of quantitative trading behind and go to the heart of macroeconomics and making money, and I guess what some people would call more old-fashioned ways. But they're very interesting trade ideas. Let me introduce the panel. You have the bios, so I'll just do a very brief introduction. Our first speaker today is going to be Joe Mezrich. He is the managing director and head of quantitative research at Nomura. Prior to that, he ran the quant and derivatives research at UBS, where they were ranked #1 by Institutional Investor for global quant. Prior to that, he was the head of quantitative strategies at Morgan Stanley, and there he was a member of their macro team as well. Prior to that, he was the head of equity portfolio analytics at Solly. So clearly a very illustrious career across many of the firms on the street who've done quant. Sitting to my immediate left is Ayman Hindi. He's a principal of Platinum Grove Asset Management. He's also a member of the Capital Allocation Committee there. That firm was founded in 1999. Prior to that, he was the main strategist in the fixed income area at LTCM. Prior to that, he was a professor at Stanford University. Sitting to my right is Jean Karoubi. He's the president and co-chief investment officer of the Longchamp Group, which he founded in 1981. The Longchamp Group invests in a broad variety of alternative and some traditional asset classes, runs money for institutions, high net worth, and some very well-known wealthy families. Prior to that, he was the president of Duty Free Shoppers in Paris and the president of General Atlantic Inc. here in New York. And sitting all the way to my right is Patrick Duez, who has recently co-founded, along with Guy Weiser Pratt, WPD Partners. He is running a private and event-driven fund there. Prior to that, he co-founded Vinci Asset Management, which is one of the larger European activist hedge funds. So he brings a very interesting perspective on that, and he also is the chairman of a knitwear manufacturing company in Monaco. So he actually does non-financial things as well. So with that said, we have quite a panel. We actually have some really interesting trading ideas across equity, fixed income, in the global macro, and in the commodity space. And I'm looking forward certainly to hearing how we're all going to make a lot of money. So Joe, you're up first.
Thank you, Tanya. Just okay here, right? I'm going to use some slides. I did not plan it this way. That's not what I wanted to do. How do we get to the present? Does anyone know how to work this thing here?
That's a way to. We shot that yet.
Okay, I think we should. I wanted to show. There we go. All right. This. No. Sorry about that. Talking on yourself. Articulate, I know, but I can't really describe pictures that well, so I want to kind of show you some pictures. And not expected this to happen, but it actually connects obviously to the talk before, but curiously to a lot of discussions that we've had this morning. Two trades. One is an equity trade, having to do with the weirdness in the market, an idea, and the other is a commodity. Thank you. Another is a commodity systemic risk idea. There are issues that are problematic, but I want to go through some observations which I think suggest something to them. Let's see if we can do it. So, the session before, I think Matthew C. Brown mentioned it, maybe Jack Twain mentioned earlier. Momentum is pretty weird lately. So how do you define? And a lot of people aren't quant equity people, so I have to define what I mean by momentum. So in these charts, I show you our factor returns And the way I do that is take a universal Russell 1000, sort it on a factor, momentum being an example, and show you the cumulative return to a monthly rebalanced portfolio that's long the decile of the best on a factor, short the worst. So there are 2 deciles as a long short portfolio. So this chart is showing you the cumulative 1-year return back to 73 of price momentum and book to price. And one part of this chart is really great. You see here why all quants use momentum and value because they're pretty nicely negatively correlated. They're very diversifying. And you also see the fact that momentum is huge, as I think a couple of speakers mentioned, and value has been crushed as financials have been hurt. Okay, so what I want to basically amplify the spread is showing the next chart that the spread between momentum and value, the fact that momentum has done great and value has been crushed, is not unprecedented, but we are now at January 2000. Okay, the tech bubble level. Okay, so the question we're going to ask is what happens next, but it's really more interesting in this chart because usually quant factors are decile spreads, but where's the damage done in value? It's the cheap stocks getting cheaper. Where's momentum happening? It's losers keeping losing. So let's kind of go a little more focused on this. So if you actually focus on what's really happening in these 2 factors and bring it back in time, this is kind of a busy chart, but I'm showing you the cumulative 1-year return of 2 long positions, a basket of stocks that's always owning the cheapest stocks in the market based on book to price, and a portfolio that's owning always the lowest momentum stocks in the Russell 1000. These are deciles, and I'm rebalancing monthly. So these are 12-month cumulative returns. The observation in this chart is that as of last Thursday, it's still true, the cumulative 1-year return of this portfolio is the only precedent is the September 30th, 1974 position in this portfolio, which, by the way, was the bottom of the market in the 1970s. So the observation that the thesis is mean reversion happens is maybe not as precise as some people like, but the idea is that as the value has been crushed, momentum has been powerful. Interestingly, it is the long side in these portfolios that are the participants. So to ask the question, does this continue and participate in the opportunity upside, it will be long position in these 2 portfolios. So what is the opportunity? So it turns out if you had bought not just the September 30, 74 example, if you look at the bottoms, there are a couple of situations there. Say July of 1982, or August of 2002, or October 90. Had you bought this portfolio at those low points, the subsequent return would have been, on the average, 55% of the subsequent year, outperforming the markets obviously well also. So I'm not saying you should time it this way. In fact, what's interesting in these prior examples in this chart, if you go to the 02 crisis, okay, value got crushed then, momentum, losing stocks lost. Had you bought it at the low point of August 02, you would have struggled for a number of months, yet still the subsequent return over the following year would have been 60%. So the idea here is that you don't have to time this. The idea is that there is an extreme situation in the market in terms of these 2 factors. Interestingly, long positions can be taken. To do this, you have to rebalance monthly, so it's not simply a matter of owning them. You have to have some swap, and we would potentially, talk about a delta and derivatives product. If you want to worry about timing, you can do a knock-in option on that portfolio. But the idea is that there is potentially an expected return given priors, given where you are, given the dismal nature. It could go on for months as it did in 02, but the expected return could be in the order over a year if history repeats itself on the order of 50%. So that's idea 1. Is this a U.S. phenomenon? So here we get into the systemic risk issue, connect a little bit to the next topic I'm going to talk about. So I'm showing you the same pair of factors, the cheap stocks and the losing stocks for Europe overlaid with the U.S. So Europe, I'm finding, is MSCI Europe. So it turns out, interesting, so the green line on that chart is the 1-year rolling return of those 2 long positions. And if you look before 98, those 2 positions are totally unrelated to each other. And from 98 LTCM period on, they were right on top of each other. So there was a discussion in the liquidity session about connectivity and systemic risk. Here you see an example of that. We'll see more of it going on, where the markets began talking to each other. So you have the exact same trade going on in Europe now. The magnitude's lower. Japan actually has already started to turn. So the opportunity in Japan for this trade is not as good in magnitude as in the U.S., and it's already started to move in Japan. So likely that maybe is leading indicator. The idea for part one, which is long positions in cheapest stocks based on book price, the losing stocks based on linear momentum, own it through a delta one derivative to avoid rebalancing issue. The position would be a year, and it's given the priors. Not saying it's going to happen tomorrow, it could happen in 3 months, but the expected return is probably quite large. So this is an upside to the problems that were mentioned in a couple of the prior examples. Next example connects to the systemic risk point. I'm going to sort of switch to another world a little bit. The first session this morning was on the food crisis. So an observation I had on the food crisis was the following. I'm showing here a chart which is the wheat futures price and CDX pricing using markets credit default swap index. So the observation, everyone knows that the demographics and stories well advertised, but just empirically, just the observations from July till the beginning of March, both wheat futures and CDX prices doubled. They both peaked within 2 days and both collapsed together. So that's kind of interesting. You know, the demographics, I know, are powerful, but that's kind of an interesting backdrop. So you see that in this chart here. The top chart is showing the 5-year history, uses Z-score to normalize them. The bottom chart is showing you since the beginning of the summer, through the last, I think, a couple days ago, the tracking of these two arguably unrelated prices, wheat and credit risk pricing. So that's kind of interesting. Let's kind of bring it forward a little bit to another piece of the world, emerging market equities and commodities. So you know, it's well known also through the demographic argument as a relationship. It's actually tighter than many people think. And what I'm showing you here is the 10-year history of the MSCI Emerging Markets Index overlaid with the Dow Jones AIG Commodity Index X Energy. So the commodity index with energy is about 30% of that index is energy. So you take that out, and then you have the X Energy. So there seems to be a common trend in these over a decade in these two things, if you will, that people use to diversify. So let's bring oil into it. So the red line in this chart is overlaying the full Dow Jones AIG Commodity Index, so it wiggles a bit more, but you could still make the case as a common trend between emerging market equities and commodities over long horizons. That's kind of the idea. So let's look at some more data here. More recently, this is a busy chart, and it's purposely busy because I'm showing you since the summer an overlay of 4 arguably unrelated topics. I have the commodities index, wheat futures, credit default swaps, all normalized, and they all move together, all peak in March, actually before Bear Stearns. They collapsed March 17th, but they actually peaked March 12th, which is interesting. And since the beginning of April, energy's taken off, so you see the red line, the Dow Jones AIG Commodity Index continue to go up, but the rest of the commodity index until the beginning of June said, we don't have a problem here, and then they track each other again. So it's kind of interesting. I don't, is there a bubble or is there not? Let me not go there, but let's suggest that, or maybe we should go there, but let's suggest that if over time to converge, maybe there's a spread trade on these various things that are connected due to connectivity in the global market, systemic risk being a side effect that's negative, maybe spreading the price spread to potentially positive one. So what's the spread to trade to do? So one idea that we looked at is the following. Going back 10 years in this relationship, I'm having a chart here showing 6-month cumulative spread between being long AIG Commodities Index, being short the MSCI Emerging Markets Index. Okay. So the spread, it's a pretty stationary spread. It has reached, as of last Friday, 30% outperformance of the 6-month cumulative returns of the AIG Commodities Index versus MSCI Emerging Markets. The spread is about as high as it gets. So the idea would obviously be to reverse the trade and to short AIG Commodities Index buying emerging markets, which you can do through an ETN shorting DJP and an ETF buying EEM. I got to disclose that I own EEM in my personal account. That's part of my requirement. So the spread is 30%. If you go back to the priors, in this chart, it only goes back 10 years, and not going to be priors, but the holding period in this trade as well, if it works as mean reversion should indicate it would, you have over a 1-year holding period about a 30% spread convergence, and the amount of return obviously functions how you do this long short trade, you can do options, you can leverage it, but the expectation is that things have been connected for a decade, they will connect again. Maybe emerging markets go up, maybe oil comes down, it's down $4 today, and so that's the idea. So what I've said in summary are two ideas, both empirically based. I offer it for your consideration. One is we're in extreme equity markets, which is causing problems, but we've been in extremes before, and given what has happened before, 50% comeback could be possible for the equity position. And for this convergence, it can be done in different ways than I've showed here, but this convergence between commodities and equities could also lead to, over a year period, potentially an outperformance of 30% plus, depending on the position you take. So that's my idea.
Okay. We're going to take questions on all of them after we go to the ideas. So next, Iman's going to discuss some opportunities that he sees in the market.
Luckily, I don't have a PowerPoint presentation, so I can dive through into it. Thank you very much for having me. It's great to be outside the office and share some of my thoughts about what's happening. And the first thing I want to tell you is I was talking to one of our young traders a week ago, and I just reflecting on the markets. And I told him when I started this business, if somebody asked me what do you think is going to happen to A, B, or C, I would say anything is possible. And at that point, it was a reflection of my ignorance about how the world works. And then 10 years into it, somebody asked me the same question. I would have a very articulated argument about the possible scenarios with probabilities and reasons for everything. And that's mostly a reflection of one's confidence in abilities and understanding of the world, which is at some stage in one's life is usually overemphasized. And if they ask me today, what do you think could happen, I would say anything can happen. It's the same answer I could have given 15 years ago, but for a very different reason. I really believe anything can happen. At this point, I have seen so many things happen that I'm not surprised anymore. We are at the point, and now I'm going to talk mostly about the fixed income markets in which I spend a lot of my time, where we have very interesting structural changes. The big thing, the first point in the market is our markets are short a lot of convexity. And this is not surprising because we only have one thing in fixed income. Unlike equity, people have so many stocks, so many great ideas that they can talk about. We only have one thing. You can only buy government securities and get whatever rate that the government gives you at that. Or if you want to do better, you go and sell options. You can lend money to somebody and give him the option not to pay you back, like a credit trade, or you lend a mortgage and give the person the option to give you your money back at inconvenient time and sell him an option. Or you can go and buy a structured note. And because rates were very low for a long time period, a lot of the investing community has sold a lot of options. And these options are floating around. You walk around New York City, you see a lot of negative convexity and a lot of options waiting to fall on people's heads. And we have seen some of them already fall in credit markets and mortgage markets, but they come from very unexpected periods. Just this month, and I know a lot of you might be aware of this, but I just repeat it for the people who are not very focused in the fixed income market. We have these called non-inversion notes, where an investor would say, I don't really like the rates that I'm getting in the fixed income market, give me more. So you say, okay, I'm going to give you a higher rate as long as the spread between 2 points in the yield curve, say 2-year and 30-year, is positive. I'm going to give you 6% if it's positive, and if it's ever becomes inverted, you don't get anything. It looks at the graph over the last 20 years, this thing is never inverted. He said, I'm going to take the 6%, thank you very much. And you, as a dealer or somebody who's selling that, would be short that option, and you have to hedge yourself. So what happened in early this month, everybody all of a sudden became scared of inflation, and you know what happened to oil prices, you know what's happening to all basic commodities, and central banks became all of a sudden hawkish. The European Central Bank said we're going to raise rates, curve started to flatten. Everybody who was short this negative convexity had to hedge. And to hedge, they have to receive and to exacerbate the move. And this is really the problem with negative convexity. Something that's supposed to move 10 yards, it gets moved 40 yards because of negative convexity positions. That statement from the European Central Bank cost Wall Street dealers almost $2 billion. And if you read your Bloomberg today, you see some European banks disclosing losses because of just that. So that's kind of one problem that we have to deal with. The second problem is the risk. The other thing that I also want to emphasize is that there is hidden convexity that you don't see, but we see all the time. And if I point it out to you, say, yeah, it's obvious, but it hasn't been obvious to me for quite some time. People like me who spend their time in the level, whether in a bank or in a hedge fund or so on, are by definition short convexity. Even if we don't touch an option or we deal in an option, we just deal in a very linear product, the nature of the arrangements we have with our creditors, the nature of the return stream that we promised our investors, makes us very sensitive when we lose money. When we lose money, we just cannot sit on our hands and we say, mean reversion, things are going to come back. We have to respond. We have to cut our positions in order to be able to survive. We are leverage players, we have counterparties, we have investors, and so on and so forth. So we have a lot of hedge funds out there, we have a lot of investment banks, and we have a lot of activity in the market. So that negative convexity, on top of the negative convexity that's coming from the real world, is floating over New York, as I said. Then the second problem is we just have very low capacity to handle these flows. The capital that's devoted to this is, I would say, very stretched, to some degree broken. It's not available in the marketplace. The risk appetite is very low, so the movements become very, very large. And then the third thing is we do, at this point in time, have genuine uncertainty about the world. We really don't know what the world is going to look like in the next 1 or 2 years. Do we really have a big inflation problem and gas is going to be $6 next year? Or do we have a big recession problem and we have unemployment rate of 5.5, 6, 6.5 next year? We don't know. We don't know whether the central bankers are going to do the right thing, or they're going to do policy mistakes that could be very, very costly. And I just told you, one statement in one morning cost $2 billion to a lot of people. All of these things together lead to one simple observation, which is we have a lot of fat tails. We're seeing things that we have never seen before. And I'm glad that the previous speaker showed you a picture. You look at his picture, even in his own market, it's something that has not happened in the last 30 years. It's very upsetting. I could bring you 10 different things that are off the charts. And the reason they are off the chart is the combination of all these things together. So how do you survive in such a market, and what do you do? I think that really depends on the constraints that are placed on your investing ability. If you are an investor that doesn't have to worry about mark-to-market, that does not have to worry about leverage, say in your own personal investment, or if you are managing real money, you have to worry about, it's a great time. There are lots of very cheap assets there that you can put and have a very decent return in the fixed income world that's better or beats what's available in the equity world. I can give you 3 or 4 examples for your personal account, if you are interested after that. But if you are a leverage investor that professionally runs money under the rules of leverage and under the rules of mark-to-market that we all have to live with, you have to adopt a very different attitude. And my advice or my trade recommendation is there will be a lot of these 10 sigma events that's going to happen more frequently. It's going to happen. The summer is here. Everybody's watching the European Cup. We have the Olympics coming in August. September is going to be pretty problematic. So there's going to be a lot of dislocations in the marketplace. So I would that you have a lot of money in cash, you take your risk exposure down, and you sit at the edge of your seat waiting to see these 10 signal events, and when they happen, you capitalize on them, and they will happen, and they tend to be very, very good opportunities. It's very difficult to do that because your natural tendency is to be involved every day and to try to justify to your wife that you go to work to do something useful. But sometimes just sitting on cash and waiting for the opportunities to...
Okay, for the girls or to your husband.
Yes. Yes. I remember from my teaching days at Stanford, I wasn't allowed to make any jokes other than of myself because anybody make a joke about it would be offended. So I always refer to my own situation. So, so I just the advice is just to be in cash and wait for all these opportunities to happen, but also be very disciplined in your risk management because some of these opportunities that look great on Monday is going to look much, much better on Friday, but you will be crying because you lost so much money and you can't add to them. So be disciplined. Don't put all of your eggs in the great opportunity of all times because there will be a lot more of those coming. And if you are wrong, just get out very quickly. I was the trade that was just presented. I thought I'm going to be very clever for my own situation, personal account. I saw everything normalizing. And I said, oil is going to normalize. It's 120. Let me short some oils in my PA, and as well as gold. Gold came down, but oil continued to go up, and I was completely wrong. So you can be wrong very easily. So you have to be very disciplined, and you have to be very careful. I think the risk reward is attractive, but has to be very humble in front of the markets that we're seeing right now, and always be ready to be wrong and try to live for another. Thank you.
Okay, I guess I am next. I am not a quant. Actually, Tanya asked me to be advisor of the IFE for a few years, and I didn't understand anything, so I resigned after a while. This time I understand what Ayman said. That's a great trade. I understand stay in cash. That thing these days it's possibly the wisest type of trade you can do. We're in the middle of dislocation. Let's be simple there. We have seen, as Ayman said, more than anybody would have thought would have been seen in the market. And we're in the middle of it. We're not out of it. Any kind of dislocation, it's nice to see dislocation according to the past. But the past obviously has shown us is not really a reflection of what we have seen and what we will be able to see. So trade, relative value trade, were possibly great for a while. They became more and more dangerous. Obviously, risks were less and less remunerated, and when you try to be very smart, catching bad quality and arbitraging that against good quality, as long as you are a hero, it works. As long as the world is rational, it could work. But then it falls. So it has fallen. It's wonderful. Let's see where the opportunities are. The opportunities start to be everywhere. It's like I used to say, we are starting to see the sale in the toy shop. So it's time to start shopping before waiting for prices to go back whenever we come closer to Christmas. And so what different areas we can see? Obviously, we have seen the two obvious risks that no quant can really quantify is liquidity and correlation. They are broken regularly. I guess I've seen that 10 years ago, and where I see it again. So we don't know if it will be in the next 10 years or it will be in 6 months after things get better. Things always get better. Could happen again. So in period where things are not cheap, you cannot rely on this type of parameters which are so elusive. Liquidity has disappeared. Obviously, very easy. The whole financial system, I think lost 400 billion, and people can foresee that we're about 1/3 on the way of destruction of assets. So we cannot rely on it. So what do we saw a lot of large dislocation. So, unfortunately, they are not automatically in liquid market. Actually, they are where the liquidity has disappeared. By definition, they are in the less liquid type of opportunities. So I'm addressing now for people for your own money or for the part of asset management that some may have, which are longer term. In period of heightened volatility, you cannot do short term. It's simple. Short term you can lose. Longer term you go for trends and you focus on deep value. What are the deep value? Let's get some simple example. Why not looking at development land in California? I just looked at a couple of property which are sold by developer who are distressed, need the money, have no way to keep those properties. Nobody wants to buy them because people believe that forever there will not be a construction of one single house in California. Okay, fine, maybe I take the chance. That type of risk I understand. I don't need highly quantitative strategies to figure out that it's kind of a nice place to be until we get an earthquake there. People want to go there, and land is as a premium in nice places. You just go to the hill above the sea level in order to be a waterfront in a little while. And out of that, it's possibly a stupid investment, but kind of easy investment. You look at to less liquid markets. I've been looking at Vietnam for years. Things were bubble, expanding more and more. All sorts of problems there. Inflation is 25%, corrupt governments, etc. Every market has fallen 40% and going down more. Who wants to go to a place that crazy? I saw a lot of places which are crazier, where you make a lot of money. Inflation is not a problem when you buy real assets. The government, there are worse government in the world, maybe in America. Quite frankly, I feel that buying assets there, 1/10 of the price of people scratching their head, trying to find, figuring out if the momentum stock or the growth stock or the value stock in the US will do better in relative term. I don't like relative term, I like making money. Plenty of other examples. You have, so that give you some example in large dislocation. You have also long term, not expensive, which got slightly cheaper. So there are solid places. What is the most solid places in the world today? I wonder if people think which is the best place to buy solid assets in the greatest economy, best run country in the world. No, nobody. Anybody wants to answer that? So maybe, Then I will say what I think, and anybody disagree, raise their hand. It's Russia. Anybody disagree on that? Best government, cheap assets, best run, the energy fund there, they don't care if the oil decreased by 50%, they have enough money for the next 5 years to sustain their capital expenditures. It's perfectly run. Assets are cheap. You see the growth of purchasing power. It's one of the largest in the world. It's kind of interesting to look at highly well-run companies which are linked to consumers. In the US, you want to short them. Short is dangerous. I prefer to go long where people make more money than trying to go short where people make less money. The game is much less risky. Let's continue now on other type of assets. Interesting, real assets. People believe commodities. We have heard a lot about commodities. Yes, commodities are wonderful. The trend on the long term is wonderful, but we have seen a lot of correction there, which could be dangerous. So how to find commodity cheap? So I go to my kind of derivative, which are buying assets which are within bundle type of instruments. They are called companies, they are easier to understand, that's collateralized, whatever. And there you can find a lot of companies. Actually, because we have seen today a difference of value of the companies which are hold commodities versus the commodity itself. And there is a game there. You see a number of dislocation. You can go stock picking. You can, one trade I am in that you can compute on a very quantitative way. You buy an oil company with proven reserve, that the price is cheap, that they have also potential of enormous discovery, but you discount that for zero. You take a price today, or gas or oil, depending on the company, and you see that price, there is a potential of doubling, at less than today's price. It has a discounted price. So you buy that company. You can certainly make some short of the underlying commodity, gas, oil, whatever. And you can also, since it is a company, there is some correlation which occur only in a very large movement of markets where you need to protect against the entire equity market. So you can take some kind of out of the money, put of that. You ask your quant guy in your office to compute how much. Then you calculate what he has computed for you, and you do it yourself at a level which can do on the back of an envelope. And out of that, can give you a name of a trade I am in, a little company called GeoPetro, which we bought at an average price, I think, of about $265. Difficult to get. It's not liquid. You have to place an order everybody, to buy $4 million. It took me 5 weeks or something like that. A bit more. We just completed actually the last purchase a few days ago. That's why I'm telling you, otherwise I would have not told you if I still something to buy there. And we did exactly that. We protected it by shorting energy and also an out of the money put on the overall S&P. By the way, that company is reserved in Texas, and there is some stuff in Indonesia, I don't know where, discounted for zero anyhow. So that's the kind of because of all this dislocation, you can find this interesting trades which kind of out of the radar screen of a lot of people. I'm going to stop there. I have a lot of other ideas. It's, again, you get into the store, toy shop, you see many of these toys which start to get at a very, very cheap price. But I still like your trade of cash because there is more to come. So don't spend it all right now. Wait until, as we say in Hong Kong, we get further reduction. There's always a sale, and then the second level of sale, and then the further reduction. There you get things really cheap. Okay.
Thank you, Tony. Well, it must, after the previous speaker, I have to also, for full disclosure, say that I'm definitely not a quant, and basically mathematically challenged. So I'm not gonna give you any formulas or anything like that. But I am going to suggest a way to make money, and it's a way where. In my previous life, we made quite a lot of money, some very good returns year on year, and where I firmly believe that it is totally independent of market movements. Last week I was in Monaco where I attended the GAME hedge fund conference, which I guess is one of the largest in the world, and I actually was a moderator on the panel on shareholder activism. And so what I thought I would do today is share some of my thoughts as to where shareholder activism is going, which is obviously colored by the panel discussions we had last week, and also talk about some of the developing trends. I think obviously, listening to everyone's concerned about continued financial instability. I don't think that for a number of you volatility is an issue because some strategies thrive on volatility. But at the conference, there were about 3,000 delegates, and they were asked to quantify the strategies which were going to be the most successful over the next 18 months. And global macro got the most votes, followed by distressed. Event-driven strategies, which I'll use as a proxy for shareholder activism, came very low with less than 10% of the votes. I really don't think that this does justice to activism. Because it seems to me that many investment strategies entail making directional bets. They're educated bets. You hedge your bets, but they're still bets on a direction, on a movement of the market. Successful activists don't do that. They don't look into crystal balls. The movement doesn't make any difference. What they do is really homework in terms of trying to find companies that are where through applying certain techniques or certain moral suasion can be restructured in one way or another to unlock value. And by doing that, they really do create the event. I mean, I firmly believe that. Now, of course, I mean, activism, of course, is not immune from market movements. It would be foolish to say that it is. It's very unpleasant to buy a stock at 50 and 3 months later find it at 30. But for the pure activist strategy, should be judged on getting from point A to point B. I mean, it's what happens in between is irrelevant, or should be irrelevant, because really what you're looking at is the performance you will get in terms of internal rate of return on your cash at the time you sell from the time you bought. Now, to be able to pursue these strategies, you need to have investors that are, let's call them sticky money, and it's really more pension funds than anything else, because fund of funds are, they look at their monthly returns, and if you have volatility, if you have everything, I mean, it just drives them crazy. They can't sleep. So it's in that respect, it's very much like private equity, and in fact, there are a number of similarities and but also differences with private equity. I think that the differences are more interesting because they actually, I prefer activism to private equity, and I think that the difference, will give you the reason. First of all, we're much more liquid. We're not stuck in any one situation. Easy to value your positions. It's market valuation. There's no argument on that. No control premium when you go in to buy your stock. Therefore, and in fact, the best protection in a way you can have as an activist is to buy low. Which is why, by the way, when markets are going down, well, not when they're continuing to go down, because then you're always afraid of your entry point. But weaker markets favor activism. We can average, if we come in too early, we can average our price down when the markets continue to go down. Private equity can. And whilst we don't use leverage, and I mean, I think, as you know, some of the hedge funds that have been using leverage these days are the ones that have been really penalized. Activism, you don't use leverage. But you can actually leverage of some sorts with the use of derivatives. So it's really not that bad. Now, one of the things we're seeing is some of the private equity houses are in fact moving into the activist space, and they're doing that because, well, quite frankly, they can't find enough acquisitions on their in their area, and probably saw TPG a few weeks ago, stake in English bank. But interestingly enough, we're also seeing activists moving into private equity. Not in the developed countries, but in the Far East and in Japan. And the reason for that is that, for example, in Japan, up until a few years back, the banks really played the role of shareholder. And every time there was a problem or anything like that, the company went to its bank and the bank would sort it out. Well, that's not happening anymore. And so these companies now are looking for support of sorts, and I'm talking about companies that are not public. And what this fund manager, this activist fund manager, was telling me is that through just their years of doing activism in Japan, and doing it in a way that is soft, as opposed to the aggressive Anglo-Saxon way, they've developed some very good contacts, and basically through those, companies come to them and say, "Can you help us? We need help," and they are taking stakes. And so this particular Japanese activist fund is in fact creating side pockets for private equity. So there is definitely a convergence between private equity and activism in some area. Briefly, in terms of geographic markets, I think the U.S. is probably the most difficult. It's very dependent on proxy contests and litigation, which is expensive. And on top of that, the goalposts are being moved constantly as during the state of game. I mean, you just have to see what's happening with CSX, and it's just so it's very difficult to really analyze at the outset, or to have a framework that you can work with, because basically it's moving. It's a moving target. So I would say that the U.S. today is a difficult market. The European market, for many years, we didn't have litigation, or very little. Proxy fights we never had, because it's mostly bearer shares. And yet today, some of the U.S. influence is moving over to Europe, and you're beginning to see litigation, and but it's not as disruptive as it is over here, and I would suggest that there's still a lot of opportunities in Europe to make quite a lot of money. And when I talk about, I mean, the returns that certainly my old firm achieved year on year were in the after all fees were 35-40% returns annually. So it's reasonable. It's good money. And really with no risk, because there's no leverage, and you just you actually sleep quite well at night. I think the markets which are really interesting today are the developing markets. If you look at Japan is already, don't want to call Japan the developing market. If you look at China. Well, I was talking to an activist in China, and said, look, our approach is really very simple. We take positions in companies, and basically we become their PR advisor, their consultant, not unpaid, and what we try to do is get them to improve their accounting procedures. We do roadshows for them. We just basically we tart them up, and that creates value. It really creates value from the shareholder's perspective, and so it's a very simple way, and one which I think anyone can understand. If you clean something up and make it more attractive, you create value. So it's not works quite well. And I don't know about Vietnam yet, although I'm actually quite interested in Vietnam, so I'll have to talk
Actually,
about
China is great. It's very interesting. Actually, to give another tip, there is a fund being raised right now by American Securities, a good American company, which has an office in Shanghai, and they are doing both a fund of those exactly type of private equity fund plus co-investment for 40%. And they have this type of investments have almost no downside unless China explodes, which is kind of a downside.
Yeah, but that's, if it explodes, we'll have a problem. So anyhow, those are a few ideas. Now, I think activism is a specialist activity which has constraints. It's not something that you can do behind your computer behind four walls. There's a time horizon of 2 to 3 years. Be prepared for that. So there again, you have to have investors who are prepared to stick with you for 2 to 3 years. It entails a high degree of portfolio concentration, which means that there again, in volatile market environments, your performance you may have significant deviation in terms of performance with the market indices. So there again, depends who your investors are. And then an interesting thing, certainly in the developing countries, is that national authorities can play a role in promoting or hindering foreign shareholder influence. But that can go both ways. You probably all heard of Bill Browder, who runs Hermitage Capital, and he did very, very well a few years back in Russia because his shareholder focus was very much in alignment with what the Kremlin wanted to do. And then when the Kremlin changed its point of view, well, he was basically said, if you come back, you'll be arrested and put in jail. And that was that. And the bill never went back to Russia.
You have no right to go back.
No. So, but the point is that the system can work for you for a time, and you can. So, government officials, you can actually sometimes ally yourselves with them. And quite frankly, I've been I was involved in activism in Europe. And we would talk to government officials, and we would talk to the opposition of the government to try to get their support and things. So it's all, those are all constituencies. I mean, you play that game. So it's everywhere, not only in developing countries, except that you don't end up in jail. I guess that's the thing. So anyhow, it's just a very, very short overview. I just leave you something which actually quite amused me, again, at the conference last week. A market allocator asked an activist, with dislocation, do you really see opportunities going forward? And he just said, I feel like a mosquito in a nudist colony. So.
I'm going to just summarize a little bit these and then turn it over to questions. I think one of the themes that was consistent across this is longer horizon trading. Looking at the dislocations on a quant basis, that are things that have happened 30 years ago in Joe's case, in Iman's case, things that are happening at most once every 10 years. Iman's is really a sort of negative convexity trade squared, and looking a lot at the behavioral finance side. And I think that's something that we're going to see a lot more of the cross-market opportunities. The long-dated, if you have cash at hand and can stand some mark-to-market against you potentially, and don't necessarily need to liquidate opportunities. And then the activist side, which is really growing, and actually you have to start to even think about on the quant side whether or not you treat stocks differently that are in your quant trading universe when they come under activism. But in any case, all of these trades are things that look to have huge returns across regimes, and also certainly a lot more Vietnam, and Patrick in the activist space, or other markets, because most people up here actually trade across other markets as well. Yeah.
I have a question for Joe Mesrich. I was wondering if you can imagine a circumstance under which the value versus momentum divergence that you've seen would persist for another year, and if so, how would you hedge that if you were going to put on that trade?
The question is, what if the value momentum spread continues to deteriorate for another year? And that can certainly happen. I mean, there's one prior, the example I gave was actually the 2002 crisis, where the entry point could have been August of 2002, because July of 2002 was the worst point. It didn't start to recover for not a year, but for 4 months, actually. But the returns were there when the explosion happened. It could happen for a year, yes. And I think the way to think about that, I mentioned the idea of a knock-in option. The first way is to think about this whole extreme question. I mean, extremes, fat cells can continue to get fatter, obviously. There's no reason this can't continue to deteriorate. A year horizon is picked rather than 1 week, right? If there's some, and again, the prior to 2 where there was no urgency in getting in at one point, make a difference. But I think if you're really concerned about that, then use a derivative strategy, perhaps do a knock-in or something like that, where you can collect some premium. And if you're wrong and it goes up tomorrow, okay, well, you got the premium. So I think if you, so it's not, the precision of the timing is not that critical. A year could be an issue, a quarter would not be an issue.
Yeah. You mentioned some ideas for your personal portfolio, and if you're willing to share to the floor audience, if not all at once.
Now you take me to dinner. I think there are lots of great things. So, for example, just in the fixed income world, if you have some cash, you look at bank preferred shares. So I bought for my kids Citibank preferred for years at 9%. So they pay you 9%. It's qualified dividend, so you pay a little less tax than. So I think that's pretty good. It's for 10 years to get that. It's very close to getting an equity return. And I'm not really worried that Citibank is not going to be here for 10 years, because if they're not, then lots of other issues that I have to worry about my kids for. Munis, I have a mortgage at 5%, and then in March, I bought Connecticut Munis for 20 years at 5%. And you think about that, it's an arbitrage, because I'm paying 5% and the government is picking up close to half of it, and I'm receiving 5% tax-free. So I could pay my mortgage and I could pay my property tax from the income, and it's close to an arb. So there are lots of things like that in the fixed income, but you just have to have real money. Don't leverage that, because you don't know how this is gonna expire, and you just collect the cash and the interest.
I know this is a question for Patrick. I know there's been some events and controversy with respect to Atos and Valeo in the French market. What's your thoughts in terms of France as a good space for activism, and are there better European countries?
I think France is a good space, and in fact, if you see, talking about Valeo, just last week, Guy Weiser-Pratt, whom I know, took a position in Valeo also, and the stock price went up just on that. which means to me that there are people within the French market who actually believe in activism and will follow when people come in and try to do things. There is support for those people to go out and do things. France is not a difficult place. I mean, we in my previous life, we were involved in actually one of the more probably sensitive issues having to do with Gaz de France, Suez, and the whole rejiggering, basically, Suez, Electrobel in Belgium, and the whole rejiggering of the French energy system. And it took a long time. I mean, we worked on that for 3 years. We had a lot of political opposition. But net, after all fees, I think we made a return of 50%. So it's no. I believe that France is a good market. I think Italy is more difficult because in Italy there's much more. I don't want to be. How can I describe it?
Politically incorrect.
Well, without being politically incorrect. It's harder. It's less clear who is doing what to whom, and I think that to be active in Italy, you really have to be part of that sort of mafia. And I'm talking about the finance.
Talking about the investment
I'm
mafia.
talking about the investment. Oh yeah, no, it's got nothing to do with the investment, which is and
Talking about the bad one, not the bad.
it's Italy's difficult. And then Scandinavia's been very easy for a number of years, but they're very clear cut and Belgium has been good. Holland, we were very active in Holland, and although we're again my old firm, we became persona non grata in Holland because they thought that we were doing too many things in Holland, but that worked well. The UK obviously is the most sophisticated market, and therefore, but also one that has very strict rules, which is good at times. What has happened? I was saying that in America that they're changing the goalposts. Well, that is actually happening today in Europe also. I mean, as we were in some campaigns in Holland, they were really trying to change the interpretation because nothing had been ingrained in law or anything like that, and they were trying to, as I say, move the goalpost. But I think generally, it's a good environment. It's a good environment, and it's an environment where you have legal systems that do protect you. I think at the end of the day, you even though I'm saying it's you don't and you want to avoid being litigious. You do want to, if you can operate in countries where the law is solid, I think it's helpful.
So I think we need to wrap up. I'm going to end with a question for Jean. How much cash should we have in the portfolio?
I would say we are still unraveling. There is much more to come, I believe. So I would say, again, if you don't mind the mark-to-market, and there are great opportunities. If you can get richer later, you can still get rich today. So I would say more than 50% certainly could be already invested, and there is certainly relatively quicker considering the volatility of the market and the number of things you observe. such large moves. And, but certainly the trying to find ways to buy things cheap, not automatically directly, because that's where it's more obvious there is a bubble. But the kind of trade I gave example, which is not that different from the trade we saw about being long emerging markets and buying short energy. I prefer to be long energy behind an equity than an index which could move much more different. But this is some type of trade that we're talking about. So this kind of trade are interesting. There are a lot of low risk, never no risk, but in the longer run, the world is what it is. We have scarcity of resources. Things are not going to change. So if you can find this kind of large, easy trend and make them as safe as possible by dampening the volatility, you can always possibly get cheaper. Let's not get greedy. Let's start investing money.
So I'll say thank you to the panel. They're around in cocktails if you want to get additional trade ideas that maybe they didn't share in such a larger audience. Thank you very much.
Thank you. Cocktails are right outside. Thanks.